Worker classification is a payroll landmine. If you treat someone as an employee, you withhold income tax and FICA, pay the employer share, and report on a W-2. If they're an independent contractor, you generally don't withhold, but you may need a 1099 NEC. On the EA exam, they love questions that really test consequences, withholding, payroll taxes, and which form gets filed. Now add the weird IRS hybrids, statutory employees and statutory non-employees. Statutory employees get a W-2, but they report income and expenses on Schedule C. The key perk is no self-employment tax because they're treated as employees for Social Security and Medicare. Statutory non-employees, like licensed real estate agents and direct sellers, are treated as self-employed, usually get a 1099 NEC, and file Schedule C like any other business. Family employees have special payroll exceptions, but only in the right entity type. If a child works for a parent's sole proprietorship or a partnership where all partners are the child's parents, income tax withholding still applies. But if the child is under 18, no Social Security or Medicare. Under 21, no FUTA. Put that same business into a corporation, and those exceptions disappear. The entity choice changes payroll taxes. Spouse wages are another favorite trap. In a sole proprietorship, wages paid to your spouse are subject to income tax withholding and FICA, but not FUTA. Change the facts to a corporation, and FUTA generally applies. Change it to a partnership where the employing spouse is a partner, and FUTA can apply there too. On exam questions, always ask, what's the entity, and who legally employs the family member? FUTA is employer only. Employees never have FUTA withheld from their pay. The basic federal rate is 6% on the first $7,000 of wages per employee per year. Most employers get a credit for state unemployment taxes up to 5.4%, which often makes the effective FUTA rate 0.6%. FUTA is reported annually on Form 940. Once an employee hits $7,000, FUTA stops for that employee. The trust fund recovery penalty is where payroll gets personal. Trust fund taxes are the amounts withheld from employees, federal income tax withholding, and the employee share of Social Security and Medicare. If those aren't paid over, the IRS can assess a 100% penalty equal to the unpaid trust fund amount. It can hit any responsible person who willfully fails to pay, owners, officers, even a check-signing bookkeeper with authority. 2 exam words matter: responsible and willful. Responsible means you had authority over payroll decisions, signing checks, directing payments, controlling funds. Willful does not mean evil intent. It can be a voluntary choice to pay other bills instead of the IRS or reckless disregard. So, "I didn't mean to" is not a defense if you knew payroll taxes were due and chose to pay the landlord or suppliers first. Summit Capital Partners Incorporation is a C corporation with over 1,000 shareholders and pays dividends quarterly. During the year, the IRS notifies Summit that the Social Security number for one shareholder, Ethan Parker, is incorrect. What is Summit required to do? The choices include reporting him for fraud, or correcting the error, or starting withholding at either 37% or 24%, or holding all dividends until the SSN is fixed. Think about it. The correct answer is correct the error or withhold at 24%. That's backup withholding on reportable payments like dividends when the payee's TIN is incorrect and not properly corrected. The tempting wrong answer is 37% because people confuse it with top bracket withholding, but backup withholding has its own fixed rate, 24%. All of the following statements are correct about the trust fund recovery penalty, except one. The options include: the IRS must prove malicious intent for a non-owner. The IRS can collect from personal assets of a responsible person who willfully failed to pay. The penalty equals the unpaid trust fund taxes, and trust fund taxes include withheld income tax and the employee share of Social Security and Medicare. Which statement is the exception? Think about it. The incorrect statement is the one saying the IRS must prove malicious intent. For TFRP, willfulness does not require bad motive. It can be shown by knowingly paying other creditors instead of the IRS, or reckless disregard. The other statements are straight definitions. Trust fund taxes are withheld amounts, and the penalty equals what wasn't paid over.